Good afternoon, everyone. Thank you for joining us, and welcome as well, Rishi.
Thank you.
From Investcorp. We're going to be talking about where to invest right now in the world. And Rishi, you're a great person to have this conversation with, because across Investcorp, you're investing in the US, you're investing in Europe, the Middle East, increasingly expanding into Asia as well, and across lots of different asset classes. But I think, to start off with, everyone I think in the room will be familiar with the fact that the last 3 months have generated a fair amount of news flow around the state of the world and some reshaping of global trade flows and investments. So to begin with, how are you at Investcorp? How much has changed now versus 3-4 months ago in terms of how you are looking at the world and where you see those opportunities?
Sure. It's been a good 3 months for you guys.
Yes.
For sure. But you're absolutely right, Matthew. I mean, if you were to dial the clock back to, let's say, the end of 2024, leading up to December 2024, all the way from, say, 2020 itself, the last 5 years almost, the phrase that all of us got used to was TINA, there is no alternative. And many a time it was by reference to the fact, just focusing on the Mag 7, et cetera. But actually it was much more about investing behind the US exceptionalism thing, right? Mm-hmm. And you saw it in our portfolio as well at Investcorp. Historically, Investcorp was about 50% in the US, 50% rest of the world. And that 50% allocation to the US actually went all the way up to 65%. Our current allocation to the US is about 65% of our overall invested portfolio, with about 30% in Europe and the rest in MENA and Asia, but growing fast. Now, that TINA, I think that whole concept is really what is not applicable anymore. So I don't see Investcorp or players like us, or more importantly, the investor community, including the investors that we serve, suddenly shifting away from the US in a big way. But what they are appreciating more is there is an alternative as well. So it's an and story, not a versus or an or story. And the and story is there are pockets in Europe, particularly with the renewed focus inside of Europe, on really doing what they need to do with respect to fiscal stimulus and becoming much more self-sufficient in critical areas like space, defense, communications, energy, etc. There are certainly pockets in the region over here, which I'm sure we'll get to, and there are pockets in Asia, including India and Southeast Asia, potentially even China, where there are meaningful opportunities, not necessarily across all asset classes, but certainly within the private markets, where you can earn a better risk-adjusted return than you could have anticipated relative to the US before. Mm-hmm. So I think that regional diversification has come much more to the fore now over the course of the last few months than it was before.
And do you see, just as a sort of a quick aside on this point about US exceptionalism, you've got, as you mentioned, a big US portfolio, a lot of mid-market assets. I'm guessing a lot of the private credit is in the US as well?
Yes.
So how are those businesses performing in an environment where they're dealing with tariffs, dealing with some economic uncertainty? Are you seeing, any signs on business performance as yet?
So the big chunk of our private equity portfolio, I'm going to look at 3 or 4 specifics over here, if you don't mind. Big chunk of our private equity portfolio in the US is middle market business services, largely immunized from the first order impact of tariffs and trade barriers and so on. So when we did the assessment, and actually going back to your question, in the last few months, more than anything else, the area where we've been spending most of our time is actually looking at the existing portfolio. Mm-hmm. We've got $57 billion in the ground on behalf of investors. We need to make sure that is in a good shape, or in as good a shape as we can possibly have it in, and well primed to grow from here. So the first order impact on the US middle market private equity portfolio is relatively modest. Now, second order impact, if there is an economic slowdown in the US and in the rest of the world, Nobody is immune from that. I'm not going to sit here and suggest that we can dodge that. But it seems like, at least if you were to believe what the equity markets are telling us today and what the credit spreads are telling us, it seems like the worst may perhaps be overstated and behind us.
Right.
Now, businesses, we have one or two that are exposed to the supply chain emanating in particular from Asia and China, which are impacted by tariffs. There is a meaningful impact on just inventory buildup. Right?
Yeah.
I mean, the supply chain is disrupted. There's no dodging that fact. And mid-sized businesses, no matter where they are in the world, do not, by definition, don't have that same ability to pivot over short periods of time to an alternative supply chain. So having that degree of resilience built into our companies is our first priority, right? To be able to indeed leverage, our institutional learning and experience, and be able to restock the supply chain when you face disruption. So that's on the private equity side. Credit, we are pretty much most of the portfolio, again, is services oriented. And the credit quality, despite the shocks to the system, albeit lasting for very short periods, credit quality has generally held up quite well.
Yeah.
Debt service coverage has been good, and defaults have been relatively muted, certainly in the services space. Real estate is the third area that we have an investment exposure to, meaningful in the US for us, where the bulk of the exposure is to industrial warehouse logistics assets. They're actually doing great. Right? I think in anticipation of some of the reshoring that is on the agenda, and just otherwise, that whole segment has outperformed the rest of the real estate market, generally speaking, not just relatively, but in absolute terms. So, the portfolio in the US is relatively fine.
Yeah. And just while we're sort of talking about geographies before going into some of the more specific sort of asset classes, as you were mentioning, you've got this growing business in Asia as well. How are you seeing the opportunities in Asia versus the US? You've also been doing more around China as well. Is China still a theme that investors want access to, or are people getting a bit more cautious on it, given sort of some of the rhetoric that we see coming out of the US at the moment?
So I'll tell you something. We are quite fortunate. We, Investcorp, are quite fortunate, given the fact that we are where we are, right? We are from the region, for the region, of the region, so to speak, right? And that gives us an ability to be a value-added partner to China Inc., from an investment perspective, when many pockets of the world, many deep pockets of the world, are having to retrench, right? And I'm talking specifically about the US. Now, going back to the question around China, and I'll come back to the broader Asia theme in a second. China went through a cycle, right? It was a great market to go into, and then it became very moribund. And actually, what we sense is a real new opportunity set within China that is beginning to emerge. And we are also sensing a shift in mindset inside of China Inc. in terms of how they want to treat capital partners. And our recent partnership with CIC in particular is a perfect case in point, where we've joined forces with them. They are backing us to deploy capital from China Inc. into the region, and we are investing with them into China, right? And into the broader Southeast Asia region as well, but including China. So we do see selectively in certain sectors, particularly those that are aligned with national priorities of the Chinese leadership, related to deep tech, related to biotech, healthcare broadly speaking, telecommunications, etc., and renewables and sustainable energy, etc., electrification, let's say. Those are certainly investable spaces and probably offering pretty attractive returns at this point. The rest of Asia, we see a very attractive and big opportunity set now in India. India is a relatively recent entry for us because we've been there less than 10 years now, but we've gone through a full cycle. We've invested, we've divested, we've had strong realizations from our portfolio and strong returns and performance in DPI. And we see all the signs of a market that is not just large and deep, but is also maturing, right?
Yeah.
And the paths to exit, the channels for mid-market private equity investors like us in particular, are many more today visible to us in India. So we are definitely doubling down behind India. And Southeast Asia is, I think, on that same journey, but maybe a couple of steps behind.
Yeah. And just, on the Gulf as well, as you mentioned, this is sort of Investcorp's home, and where a lot of the history lies. We've written a lot over the past year or two about a lot of the big US private equity names wanting to come into the region. Is that helpful for you, or is that more competition? Does that make it more difficult for you to source deals, or how are you sort of seeing the private equity environment in the Gulf now?
We love the fact that all the players are coming in. Right?
Okay.
We absolutely love that. And I'll tell you, for a very simple reason. The more that we get the attention of the international investor community focused on the region, the deeper the market will be, the more the avenues for potential exit and realization would be. That's exactly what happens in any market. If you look at private markets overall, the earlier perception was private equity, the exit is through an IPO, right? But then, as led by the US and subsequently by Europe and now increasingly in the rest of the world, there's an entire value chain within private equity. Venture sells to growth, growth sells to mid-market, mid-market sells to upper middle market to the large cap, and so on. That value chain, when it gets established, is the best thing that can happen for not just deal flow and transaction activity in a region, but for deepening the capital markets themselves. Right? So I am absolutely delighted with the fact that my friends from Lone Star and Ardian and everybody else is in this room and looking to invest in the region, because it'll deepen the capital market and it'll meaningfully increase the maturity of the market itself and the ability to actually add value to the underlying assets, as opposed to looking for the next exit.
Yeah. And given some of the uncertainty that we've talked about around the outlook for the global economy and what's happening in the US in particular, as you speak to investors and look to raise funds, are people is there a premium on liquidity? Are people wanting to keep their powder dry at the moment, or are they still actively looking for opportunities to deploy?
Yeah, I think it's a little bit of both to some extent. I think people that are sitting on investments or commitments to funds that are a little long in the tooth beyond the normal hold period of, say, 5 years, are a little antsy. Would like to see a little bit of distributions coming back their way. There is no shortage of liquidity, by the way. Let's just get that out of the way. When we go out and we talk to our investors, but more importantly, when I'm talking to the broader community of stakeholders, one doesn't get the sense that they're short of liquidity. I think what they are looking at is the current duration of their portfolio, both from an ex-ante perspective as well as ex-post. And they're saying ex-post, I normally have 4.5 to 5 years. This is looking like 5.5 to 6 years. Do I need to make a change in terms of how I think about strategic asset allocation in the future? And that is one of the reasons why you've seen the strong level of interest in all of these vehicles that support secondary liquidity, particularly in the private equity space, but also real estate, and increasingly now in private credit and infrastructure as well, right? So you're seeing these vehicles crop up. The LPs behind all of those vehicles is the same LP community, right? But all they are doing is they're balancing out the longer duration of their core portfolio around PE and so on, with a shorter duration and expected shorter duration in their secondaries portfolio.
Right. Okay. And I don't know if you were in the session with the new QIA CEO, but one of the comments he made was private credit is now an overcrowded market, and I know it's somewhere where Investcorp has obviously had a significant business as well. How are you seeing the private credit space?
So, I mean, it's certainly grown, it's amongst the fastest growing asset classes within private markets. So let's start with that. But it is understandable why, for two reasons. One is the definition of private credit that originally started off as, direct lending to middle market leverage buyouts, right? That was the original genesis of private credit. That's expanded, well beyond its original borders, right? Now, private credit includes pretty much everything from structured credit to middle market direct lending, of course, but asset-backed finance, asset-backed lending, the whole ladder, right? And it is effectively stepping in where banks are stepping out. And if you were to look at the total credit market as a whole, particularly in the developed markets like US and Europe, but also increasingly in the emerging markets like the region and, let's say, India, et cetera, the percentage of private participation in that total credit market is still relatively modest, right? So the scope for it to continue to grow is there. Secondly, it's supported by the fact that there is a much better match between asset and liability duration between private credit assets and insurance liabilities, right? Or pension liability, long-dated liabilities, et cetera, that are looking for yield over a medium-term horizon, but also looking for that yield in a floating rate format, which is what has been the biggest driver of the increased interest in private credit over the last 3 years in particular, as interest rates have gone up from a zero floor to 4s and 5s. So that phenomenon is likely to prevail for some period of time. Where the overcrowding is being felt, I think most is in terms of the number of players in the space.
Yeah.
So there's inevitably going to have to be some consolidation. I think the world doesn't need yet another private credit platform. There are enough. So there is likely to be some degree of consolidation, and we are seeing that in the M&A that is happening in that space. That has been one of the most active domains within alternative asset management for consolidation.
Yeah. So what's your ambitions for Investcorp's private credit platform?
So it's, by AUM, our private credit platform is the largest component of our total AUM. 22 billion out of the 57 is private credit. Now the opportunity set, and within that 22 billion, about 20 plus billion, almost 21, is CLOs, our broadly syndicated structured credit platform, where we are a top 15, top 20 global manager, one of the few that is equally well positioned on both sides of the Atlantic. That platform is well poised for continued growth, and we have one of the longest track records in this space, so we should be able to benefit from that. The big opportunity for us, in addition to the CLO platform or broadly syndicated loan platform, is really around the direct lending space. There, today, we are relatively small. As I said, we don't need another player in that, but we are a player, and we think we have the right foundation to grow it up.
Yeah. And we're rapidly running out of time, so maybe to sort of further on from that point, Investcorp has grown pretty rapidly over the past decade. At over $50 billion assets under management now, there is this ambition to get to 100. So in 1 minute and 17 seconds, how do you get to $100 billion AUMs at Investcorp?
So listen, the perimeter that we need for the business to grow from 57 to 100 is now in place. We are present in the core markets that we need to be in between US, Europe, Middle East, and Asia. We are present in the asset classes that we need to be in between private equity, real estate, infra, credit, and liquid alts. Now the question really is to leverage the brand that we have, not just in the region, but globally, and serve a broader universe of investors across those core markets and asset classes to largely grow organically. That is facilitated by the fact that we have affiliation or connectivity with 3 very powerful pools of permanent capital that can fuel that growth. One being our listed vehicle on the Abu Dhabi Stock Exchange, Investcorp Capital, one being a listed BDC in the US, and the third being our affiliated insurance carrier in the US as well. The insurance carrier in particular offers a lot of potential, and that'll be the primary driver of that growth engine going forward.
Yeah. And so just
1 minute, 17 seconds.
That's very good timing. Just as a very quick follow-up to fill our last couple of seconds then, so do you see this, the growth now being organically building from what you've got in place? No more sort of plans to go out and acquire other asset managers or other firms as part of that growth?
Nothing that would go towards expanding the perimeter, but tuck-ins, yes, of course. Adjacency into, let's say, the credit space that allows us to fill out an area that we are currently not present in, but is a good fit for our insurance carrier. Absolutely, we'll consider that.
Okay, well, look, thank you very much for your time. We will have to leave it there, Pleasure. I'm afraid. But Rishi, I'm sure, is around if anybody would like to grill him some more. But otherwise, thank you very much for being here and for your attention. So that's the end of our session. We hope you found it really useful and helpful. We'd like to give a special thank you to Qatar National Bank for sponsoring this breakout session. And thank you all for being with us. You can find out more about what else is on the agenda through the QEF app or on the website. But otherwise, this concludes this afternoon's activities in this room. So thank you very much.